Imagine a scenario where you're fully invested in mutual funds, but you need some liquidity urgently for a short period of time. You have some urgent expenses for which you need cash, but you also know money is coming in 3 or 4 months down the line. So the need is purely for a couple of months. What do you do? What are the options? Do you sell your mutual funds, or is there a better way of doing? That's what we're going to explore in today's episode, my friend. In India, mutual funds are in the open-ended format. What do we mean by open-ended format? It means that you can enter the mutual fund at any given point in time and exit the mutual fund at any point in time. You can redeem your investment on any given working day and the money comes back to you in T+2 days at most, which means that it's probably the most liquid investment possible. But having said that, is liquidating an investment a good idea? Especially if you have chosen to go with a goal which is fairly long term. Let's say you have a retirement goal that's 15 or 20 years away. You're 5 years into your journey. Should you liquidate your mutual fund for a short-term cash flow or a cash crunch? What are the outcomes thereof? Now, if you were to liquidate your investments to take care of your short-term cash crunch, this is what happens. One, the money you will be easily able to take out because they are, as I mentioned, open-ended schemes. So when you put in your redemption, you will get the money into your account in T+2 days. But unfortunately, when you get the money back and you want to reinvest, the market is rarely going to be the same. So it's going to be a different market. You're buying at a different level. So there is a reinvestment risk that you will undertake by exiting in a hurry and trying to reinvest into the market. That's the first one. You're not sure of the price you will get. The second one is that it's rarely seen that you will be able to build the same portfolio. It's unlikely, in fact, that you will build the same portfolio because the portfolio that you had was built through a period of time, maybe through SIP and so on and so forth. You will not be able to build the same portfolio right again, even though you may have liquidity coming in a few months' time. Third, when you exit in a hurry, you incur exit loads, especially if investments haven't spent a year's time, then you incur a reasonably high exit loads on these investments. Plus, there is also the attendant capital gain taxation that one needs to undergo. So all this means that there is a suboptimal return and a high cost that you incur when you pull out your investments in short time, which are meant for long term, which are planned for your long term goals. So this is where I think one needs to look at, are there better options available? Is there a better way to manage? And in the answer to that is that there are products available which can provide you liquidity without tampering with your holdings. And these are called loan against shares or loan against mutual funds. Now, these are products that have always existed. These have always been part of the banking and non-banking financial services industry. They've always existed. The idea is using your mutual fund or shares as a security. These institutions will lend you money which can be repaid to them for an interest that you need to pay to them. So that's really the purpose. Now, how does the whole principle work? You walk into your bank, you have a holding statement of all your investments, be it mutual funds or shares, and then you talk to the banker, and the banker looks at your portfolio. If it's equity, generally they offer 50% of the current market price. If it is any kind of debt investments, debt mutual funds, you can get up to 90% of the current value. Having said that, based on your portfolio, your banker will give you an estimate of the amount of loan that you can access. Thereafter, he will give you a set of papers that you will need to sign. Like any banking document which you need to sign, it's in fine print and you will have to sign at least 15-20 times. right? It's a little bit of a cumbersome journey thereafter. Post that, the banker will give you something called a lien marking form or a pledge form. This lien marking or pledge form need to be signed by you and submitted to the registrar of the mutual fund that you want to create the lien on. So once you submit, the registrar will take 8 to 10 days time in marking the lien and confirming to the institution. Once they confirm to the institutions, the institution concerned will draw up the loan amount and transfer to your bank account. The money therefore can then be used by you for whatever purpose that you wanted to draw. This entire process so far in the physical mode involved you to go travel to the bank, sit with the banker, do paper-based workings and so on and so forth. Now there were obviously a lot of problems in this. And the problems were this. One, you have to find time, go and sit with your bank or a finance company physically and do these physical documentation. Second, the onus of creating the charge against the mutual fund was on both the institution as well as the individual. But having said that, since you are in a hurry to borrow, a large part of institutions gave you that job and said, if you can hurry up the process, we'd be happy to kind of lend money sooner, which meant that you were running around a bit to make sure that the lien was marked. Third, even if you had 3 months away when you needed the money, because the loan is sanctioned, the money gets written off to you as a check or transferred to your bank account. So the interest starts ticking right from that day onwards. That's the third. Fourth, the cost of this whole thing in terms of time, energy, and effort, just too much for many people to really go after. So this whole loan against shares or loan against mutual fund was largely restricted to some very high net worth individuals who were doing big promoter holdings in this form and so on and so forth. Never really got down to a retail product that was available to you and me. So that was the scene till very recently. Now, of late, you have a bunch of very smart fintech companies. These fintech companies have managed to digitally crack the space, taking a loan as easy as having a cup of coffee for you and me. How do these apps work? Simple. Download these apps from the App Store and log into it using your user ID password. Upload a couple of simple documents. It could be your PAN number, your KYC documents, and a simple check leaf of the bank from which you want to operate this whole thing. A simple process like these will get you started. Of course, you also need to upload your mutual fund statements so that the app can recognize which are the holdings that you have, based on which the app will generate a kind of a loan that you are eligible for. After you have completed all the formalities, you will be offered an overdraft facility by the app based on the security of your mutual funds. Now, as far as the lien marking is concerned in this case, the lien marking is completely digital process, which means that it happens in the app itself. You don't need to physically visit any location. It's super quick, which means that in 15 minutes, whatever be the value of your portfolio, you can derive a loan proposal through the app in about 15-20 minutes max. So it saves you tremendous amount of time and energy as well. These app companies have done a smart thing of connecting to the two main registrars in India, which is CAMS and K Fintech. Through that, they cover almost every mutual fund that's available in India. About 5,000 plus mutual fund schemes are available, and you can borrow against any of the mutual fund schemes, including debt funds and ELSS schemes, as long as they have completed 3 years of existence. What are the conditions that are prevailing on the person trying to borrow using the app? The person must be within the age group of 18 to 65 years of age, must be a resident of India, Third, the portfolio value that he seeks to borrow must be of a minimum value. Some of these companies have 50,000, some of these start with at least ₹1 lakh. There is no upper cap, but they start with a minimum. You must be a single holder in these holdings. Joint holding is not eligible for the loan against mutual fund. These mutual funds must be managed by CAMS or K Fintech. Now, K Fintech and CAMS, as you are aware, manage pretty much the whole mutual fund industry in India. In the case of equity, about 50% is the valuation that's provided, which means if you have a mutual fund holding value at 100, the loan eligibility will be 50 rupees. And if it is debt funds, you can go up to 90%. In case of ELSS, the loan eligibility is only available if you completed the 3-year lock-in period that's available on this. So these are all the conditions that are prevailing when one seeks to apply for a loan using the app. How much can one draw? There is no particular upward limit. Like I mentioned, apart from the criteria of numbers, you can do up to 1 crore and more if you have the eligibility based on your holdings. What is the repayment criteria? Should you repay the entire amount? Again, the app provides you enough flexibility. You can choose to only pay the interest on a month-on-month basis, and principal you can choose to pay either one shot, or you can choose to pay both the interest and the principal as an EMI. All those options are available within the app for you. How does the app make a big difference in this space? Like I mentioned earlier, the app has really democratized this whole process of loan against mutual funds, which means even for holders seeking the loan amount as low as 50,000 or 1 lakh can today use the app and get the liquidity. So it's a great benefit. It's really democratized it. Second, because it's a secured loan, you get the loan at a reasonably low rate. The prevailing rate in some of the apps are as low as 9.9%, which is not bad considering that you are not anyway going to redeem that investment at any given point in time. Third, it's a super quick way. Like I mentioned, it takes the time of ordering and drinking a cup of coffee, 15-20 minutes, for you to set up a loan and get that loan going. So it's double quick in that sense it offers. It provides you a relief from exit loads, capital gains, a lot of those hassles that you have. And recreating the exact same portfolio is also a challenge. Whereas going through this route means that you can kind of hold your mutual funds the way they are and use the liquidity too. So it's having two things for the price of one almost. Last but not the least is that should you want to kind of prepay the loan, there is no prepayment charges. You can close the loan at any given point in time. Take the lien out as well at any given point in time. So the whole process is digital, seamless, quick, oriented towards consumers. So from that perspective, I dearly think that going forward, should you have a temporary cash flow need, then some of these apps may make a lot of sense in terms of offering you that credit flow, especially if it's less than 6 months that you require this liquidity for. I think you should not ignore looking at these options. Would be a great way. However, one negative that any loan against share document suffers from, that is when the portfolio value plunges sometimes, and it happens once in a decade, once in 2 decades or so, that portfolio value really kind of plunges big time. So typically when COVID struck in 2001, in March, your portfolio dropped by almost 40%. Similarly, when Lehman crisis happened, the portfolio went down by almost 60%. In times like these, when markets go down pretty dramatically, if you have a loan against share and you're fully drawn on that, the company will come back to you and want you to either prepay a certain amount of money or use their discretion to sell part of the holdings to realize their capital to keep that margin that they have of safety. Now, this is the only instance where it can be a little bit painful to go through these kind of products. Otherwise, it's a reasonably good option that one must consider when they need liquidity purely on a temporary basis. So do your homework. Do not disturb your long-term compounding investment product. If you have a short-term cash crunch, use the loan-based mutual fund apps. There are plenty available in the market. You just need to do a little bit of homework and you will hit it right there.